Good morning, YouTube. I want to take a few minutes today to just talk about how opportunities will come, how we're going to wait and prepare for those opportunities, and encourage you to not be, hasty in the situation, draw incorrect conclusions, and how not to learn the wrong things. So let's get right into this. This is the sheet that I share with you about what moves I've done lately. In this environment, we've got inflation at 9.1%. We've got interest rate risk where they've said they're going to increase interest rates. And if the market continues to be good and things continue to be good, they'll keep raising interest rates, which changes the situation. And, we've got the market coming back up some and, some changes. And so, what am I doing right now? Number one, we're preparing for the next situation. We're preparing for the next opportunity. What will the next opportunity be? We need to be ready when that opportunity presents itself and be patient until then. And so at this point, some of the things I've advised you to do are to systematically save every month, to spread out your investment sum over time based on what's the right thing to invest in, to not YOLO into high-risk investments. And so what I've been doing in the real estate area right now is paying down some short-term revolving things to decrease my interest rate risks and increasing my cash. So accumulating cash in a place that if there is a great investment opportunity, I can take advantage of one day. Also a portion of that to mitigate interest rate risks as rates may go up. From an investment standpoint, I'm not shifting my portfolio into Walmart stock, but I am dollar cost averaging out of my funds, out of my own labor. So I'm working for that money that goes into that, and so I'm doing that every 2 weeks. Crypto has changed, and we'll talk about what's changed in our risk profile and how that affects our decision. And the best thing I had to tell you is don't go back and say, I made bad decisions. Say, did I make good decisions based on the available information that I had? Did I make those decisions within percentages of my portfolio? Did I understand the risks? If not, how do I better understand the risks? And when the situation changes, you change at that point. Don't hold on to necessarily an old idea. If the risk profile actually changes, just don't let emotion and public sentiment change it. Let your risk profile and the things that you're doing change, based on actual experiences and actual knowledge. So we'll talk about that in another video in a minute. So BlockFi, I'm out of BlockFi. Took all the cash out of that. Used that cash to put down some of the short-term interest rate risk. But I got out of that because there's a new risk that exists there. Nexo, I'm reducing it, but I was in positions that are held for 30 days. So if I reduce that sum, and I'll continue to, I do not understand exactly the specific risk in Nexo itself. But when you're putting money on the platform and the platform risk itself is a new risk, I'm not sure that the percent interest that they're paying is really compensating for that risk. 5% would be a 1 in 20 risk. I think the risk is higher than that, maybe 1 in 5. So they'd have to be paying you 20% interest, which they're not. As far as learning, I did buy a small amount as percentage of some stocks that I went and saw what Buffett was buying. And interestingly enough, they're very, very cheap. You're paying 4 times earnings on this, which is Paramount. They just made that Top Gun movie. HP, Citi, and Allied. So they're very, very, very cheap cost stocks from the cost standpoint. And then they pay a higher dividend. I don't know all the details about these stocks. I just know, Buffett recently bought them. So if I have something that I want to watch, I have to buy some of it to see what it feels like to be in it, the actual feeling, and see if I like it. and maybe want to accumulate a position in that particular stock. Overall, I probably only want to be in 3 or 4 stocks, and then index funds, and then real estate and some business things. And so today, that's what I wanted to share with you. Just here's what I've been doing. I remember in 2000 when the dot-com bubble burst, and you had stocks like Cisco, which were building the backbone, that crashed. You had I was in 2 mutual funds that were in kind of a tech sector that went down by 50%. And I'm not very hasty in the decisions that I make. I held the mutual funds for 2.5 years after that, just to see. It was not a bad decision. It just was a bad timing maybe on the decision. But just to see how they did, they really didn't recover very much. And those stocks that people thought were going to be the go-tos of the dot-com, I don't think they really came back. And so when they gave the impression that, Amazon, Google, and those things came out of the internet bubble, it's not really the case. There's, 100 stocks involved in the whole dot-com transition, and it changed things for Walmart, and JCPenney's went away mostly, and, it changed the company. So what I would say is, in those transitions, it creates an amount of uncertainty in some of the longer-term companies, and sometimes that uncertainty is not priced in to those companies' valuations. So be careful at that point investing. And when the bubble crashes, I'm not saying to sell it, but think about how it feels over a period of time to own it. And if it doesn't do what you want it to do over a year or so or whatever, then maybe I would consider selling it. But I'm mostly trying to avoid selling it on an emotion, which I know is the bad, kind of the bad decision process. And then I'll share with you the last thing. I'm still looking to sell my Disney. I've been watching investments and, how high it is and things. And then I'm holding Ribbon and Coinbase. But Coinbase has come back some. Ribbon is still where it is. And those are just kind of an experiment. And I'm looking for an opportunity. I'm actually DCAing at Walmart, like I said. I'm looking for an opportunity to buy some Pepsi. And I believe the market is going to take a dip. I mean, right now it has a lot of optimism priced into it. And I think that optimism is undue based on the interest rate changes that we are expecting to happen and the natural effects on those. And so just want to take a few minutes. If you're saying right now I'm not going to invest in stocks and things like that and I'm out, that's an okay thing to say, but not an okay thing to do. You can say, hey, I didn't like the way this felt, but learning the right long lesson in this situation can really cost you a lot more than learning nothing. And so you need to understand that in this situation, risks occurred that were priced into what you were doing. And if you didn't think they were going to occur, then you probably don't have a good idea of what the risks really are. Maybe your risk profile is different. But if you followed, my non-investment my advice, what I'm doing, you'd be half in, 10-15% down from the peak. ETFs, they'll come back over time. You'd be 25% in cash. You would have lost some in crypto like I did, but you'd still be in the market. You'd still be DCAing into the market. You would still be accumulating cash, waiting for an opportunity, and that's really going to make your money. So get ready for opportunities. Put your cash aside. Dollar cost average into the market. I'm not an investment advisor, but that is what I'm doing as I show you right here in the sheet. And I'll talk to you all later. Bye.